A lot of people don't really know what investing is, and especially what kind of investor they are. So even before you think about investing, you need to make an assessment of where you are. This is kind of like when you're going to the doctor and you have some kind of a problem, some kind of health problem, and the doctor is asking you on a scale from 1 to 10, how much is your pain? Well, when you're talking about investment, that's the same thing, but we are switching pain for risk. So the question to a new investor would be, how much risk are you willing to take on a scale from 1 to 10? And obviously, people don't know because they don't even understand the risk associated with investments. Yeah, definitely they understand that there's a risk in investment because they listen to the radio and they watch TV every day, and people are saying that the stock exchange has lost 20% of its value, that the 401k retirement plans are all washed out, and they think that whatever they're going to do, eventually they're going to lose money, a lot of money, and that's a big risk. So let me explain. Let me show you and explain what the scale is. And let's start with the 1 and finish with the 10. So the 1 would be the conservative side or the risk-averse side. And the 10 would be the very aggressive side. Number 1 is cash. Cash is anything that's not moving. It's like stale water. If you have a cat, you know that cat hates stale water. Water that's not moving because it can get bad very quickly. Stale money is the same. Whether you have a stack of cash under your mattress or some cash in your checking account or some cash in your savings account, that's still money that's not invested. It's not moving. It's dead money. And in time of high inflation, you are losing money. Like right now, for example, inflation is 8%. So you are losing 8% every month. So let's take $10,000. You are losing $800 every month because of the inflation if it's not invested in something that is going to give you some return. So now let's go to the first place where you can have growth on this scale. And it's the number 5. It's called a balanced or equity income fund. Your goal here is twofold. The preservation of capital, that means not losing money on the first place. And the growth of capital, that means at the end of the month, how much more money do you have than at the beginning of the month? Everything that's under 5, you are not growing your money, and you are at risk of losing your capital. And the 5 is borderline risk averse. It's so borderline, almost conservative, that if you move a little bit to the left to a number 4, for example, you're in the bonds territory where you get a yield, but there's not really any growth potential on bonds. The problem with bonds is that you don't have more money at the end of the month. Are you still following me? Let's talk about number 3. That would be like, for example, a fixed annuity. In a fixed annuity, you get every month the same amount of return, same income, and there is no growth of your capital and no growth of your revenue. Let's take the number 2. The number 2 would be a CD or a cash value insurance. Not only there's no growth of your capital in a number 2, but there's no growth of your revenue. And the returns are also very low, maybe from 1 to 2%. And also the number 1, that would be the worst investment because you are losing all your money. And let's get serious. The number 1, the cash account, is not an investment. The 2 and the 3 are very secure investment, but not really rewarding. The bonds are also secure. You are making more money, of course, but there's also a very small chance that you could lose money on a bond. There's always some kind of risk. So the number 5, the equity income, is the middle of the road. So now let's talk about the number 6. So the number 5 is first on income and then on growth. The number 6 would be the contrary. The number 6 is first on growth. You want to grow your money, and then on income. You want to make money out of your investment. The number 7 would be aggressive growth. Now, we are talking about an aggressive growth situation. We don't care about the return. We don't care if you make money on your investment. All what we care here is making you the most money possible over 8 to 10 to 15 years. That's long-term investment. And we really don't care if it looks like a bumpy road along the way. Number 8 is sectors, whereas number 5, 6, and 7 are a mix of investment. The number 8 is a concentration in a sector of the economy. Let's say, for example, healthcare, energy, gold, real estate, oil, or anything that is concentrated on a particular industry. Now, you can make a lot of money on sector. Take oil, for example. If on December 2021, you decided to invest $10,000 on oil, come in March, you would triple your investment because the price of a gallon of oil went to $50 to $160 in March. If you had made an investment of $10,000 in oil in December 2021, you would have $30,000 on March. But then the problem is that come April, the gallon of oil went down from $150 or $160 to $80. So if you had invested in March, you would have lost 40% of your return. So you have to be very careful. That's why you need to understand that the more money you can make, also the more risks you are taking. You can make a lot of money, but you can lose a lot of money too. Everything here is based on information. But of course, you don't know in December that there's going to be a war between Russia and Ukraine, and you don't know that the price of a barrel can go from $50 to $160. Maybe 5 people knew, 10, 100, but you didn't know. So you didn't invest. So you didn't make that $20,000 profit. And the other side of the coin is that in February, week after week after week after week after week, you see that the price of a barrel of oil is rising, 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 rising. So in March, you're thinking, man, the price of oil is rising. Maybe I can make a ton of money here. So you invest $10,000 mid-March and bada boom, bada boom, bada boom, boom. The price of oil is going down and down and down and down. And that's the problem because you don't know what's happening. Maybe 5 or 10 or 100 people knew that it would happen, but you didn't know. So that's why it's very dangerous. And that's why when you do an investment, you have to be aware of the risks. Now, the number 10 is even worse because that's speculative investment. Here we are talking about day trading, option, crypto, or developing country. So if you are following the news, you know that guys who had $40,000 in crypto in November lost everything in January. It went from $40,000 to $10,000. They lost millions and millions of dollars. So it's even more dangerous than sectors. And it's even more dangerous if you don't know what you're doing. So we talked about the risk, but what about the returns? Because an investment is supposed to make you extra money, right? So let's take the number 1. Here, you don't make money, you're losing money. You're losing money because of the inflation. The number 2 can give you a return between 1 and 3%. So let's say, for example, you invested $10,000. At 3%, it's going to give you $100 to $300 at the end of the year. The number 3 is going to give you between 4 and 6%. So same investment of $10,000, it's going to give you after 1 year $400 to $600. The number 4, it's going to give you between 5 and 7%. Same $10,000 invested in a number 4, it's going to give you between $500 and $700. The number 5 is going to give you a return from 8 to 10%. So that becomes very interesting, right? And that's what I'm saying. The number 5 is the most interesting and the most risk mitigated for investors that don't know what they're doing. Because if you invest $10,000 in a number 5, you can get $800 to $1,000 in return after 1 year. Number 7 is the same, but it's focused on growth, not on return. So I know at the end, you're probably making the same money, right? But you're making less income. But if there's more growth, You're making more money when you try to resell your investment, right? So the number one is the sector: oil, green energy, health, tech, things like that. So if you don't know what you're doing, just don't do it. And the number 10 is speculative. So this is like gambling. This is like going to Las Vegas and putting $10,000 on the table and don't even know what's going to happen to your $10,000. If you don't know the rules, just don't gamble. So here you are on a scale from 1 to 10, all the investors' style relative to risks. Now the question is, what style are you?